Despite the issues hurting the steel sector, Tata Steel during June quarter has recorded 11% year-on-year growth in the group revenues. Now, this was largely on account of strong performance from the India operations, which account for almost 60% of the total revenues. Let's do a three-point analysis of the earnings fine print and the outlook on the company. 1. What are the key highlights of the Q1 earnings? Well, India operations reported 19% growth in sales volumes, largely because of the good demand in the long products category. Now, this provided some cushion from falling volumes in Europe. Also, Europe, which is about 40% of consolidated sales, saw about 8% drop in sales volumes because of the low demand and planned production shutdown. Now, consolidated volume growth was about 5.3% up. Nevertheless, impact of lower steel prices had an impact and benefits of higher volumes were reduced to that extent. Chinese HRC export prices have also dropped around $500 in Q1. Now, due to lower realization, consolidated revenue grew by a modest 1.3% to a little under 36,000 crores during the quarter. 2. How was the operating performance of the company? While the revenue performance was still reasonable, the impact of higher costs because of higher iron ore and coking coal prices actually impacted the company's operating performance. Now, if you see on consolidated levels, the impact was 586 basis points, largely because of Europe and other entities which recently acquired assets. For instance, Tata Steel BSL, the erstwhile Bhushan Steel Company, raw material cost as a percentage of sales jumped from 53% in Q1 FY19 to 67% in Q1 FY20. Now, this is reflected in the EBITDA level performance as well. On a consolidated level, EBITDA dropped by 26% on a year-on-year basis. Now, both lower realizations due to falling steel prices and higher costs led to this poor performance at the operating level. Now, this also impacted the net profits, largely because of the steep drop in European profitability. Consolidated reported net profits dropped by 64% on a year-on-year basis to about 700 crore rupees. 3. What's the outlook on the company? Well, steel prices are expected to remain subdued and pressure is increasing on account of higher raw material prices. Now, these issues, along with lower demand, would also get reflected in Q2 FY20. Moreover, with the fresh hiccups in divesting South Asian business and European operations, as well as high debt in the books as a result of acquisition of Bhushan Steel and Usha Martin, we remain quite cautious in the near term.